thank you so much for coming here today. We really do appreciate it. We have this new bill that just came out. There's a lot of different things going on, a lot of extensions, new stuff, things expiring, things going away. So we thought it'd be good to just educate folks. I am Brian Statina. I am the managing partner of the firm, and love taxes. It's one of my favorite things. I know, right? I don't love paying them, but I like learning about them. And this is Tammy Worsley. Tammy is part of us. She was the director of our entrepreneurial services division, and we have Keith Kahn and Sarah Patterson over there. Keep ourselves as we move along. Faw Casson since 2006, and been pretty much a tax person most of my career. A little bit of A&A, a little bit of audits. My beginning of my career, audit. And so we're gonna go through a lot of stuff today. But I did want to mention at the end, you cannot leave unless you get a 70 on the quiz we're going to be giving. Sorry.
Yeah, 35 plus years. I know you're thinking, wow, at 10. Very nice. And but I love it. It's my passion. I was born and raised in Delaware. I love it. My primary specialty is really taking care of small and medium-sized businesses right here in Delaware, helping them with like record organization. And if we get your records organized, then we can help you with strategic tax planning. We get your return done efficiently. So the financial institutions in the room are healthy because they can get financials, right? So love what I do, very passionate. And I merged my practice in with Faw Casson already probably 13 years ago. It's been a long time. Yeah. So I've always done this kind of work and I love it. So being in front of everyone today really makes me happy. That's one thing that Faw Casson is passionate about, is really educating our clients, because we want to do this alongside with you. And the more you can understand it, it's just better for everyone. So thanks for attending today. And those that are online, thank you.
All right. So this bill was passed, was signed July 4th, which we were excited about in the sense that the last bill that happened in 17 didn't get signed till December 22nd. And it's kind of hard to do tax planning. You live 8 days, so we were able to, this gives us time to absorb it. It gives the IRS time to do some guidance on some of these issues. You'll hear us today a couple of times say, we're waiting on new guidance on that. How it's going to go last. We understand the theory behind it. How it's going to go now. So that is the thing.
And there's a lot in this bill that's not income tax related that we won't be discussing, some benefits and things like that. So our focus today is really on the tax part.
Correct.
Yeah. I'm Sarah Patterson. I'm a tax manager here at Faw Casson. I've been with the firm over 6 years. I've been in accounting for now over 18 years. Then I love taxes too. I like helping our clients. I like to worry about the taxes so they don't have to. But it's great that you're here trying to learn more about this, just so you are aware of it. You don't Brian, you don't have to memorize all the stuff. That's why it's up here. Do want you to hear. Okay, so we'll just start off with some changes for individual taxpayers. The first thing is this bill makes permanent the tax bracket that is at the job act enacted. We have tax brackets is 2018. They were scheduled to expire in the 2025 and revert back to the old tax brackets. And you might remember the old highest tax bracket is 39.6%. Now we get to keep the lower 37. And in general, all of these are lower than the tax brackets. So the ranges here are the ranges for 2025, and those will be adjusted each year for inflation. The other thing that Tax Jobs Act getting is take away personal exemption, so those are still the same. And it also made permanent the higher standard deduction. That was also from the Tax Jobs Act. It's doubled the standard deduction while removing the exemptions. So they actually increased 2025 standard deductions a little bit with this bill. And now these are going to be permanent and adjusted for inflation going forward. So currently about 90% of people take a standard deduction and of itemizing just because the standard is so high. But if your itemized deductions are being close to the standard, there's strategies you can do, like bunching your deductions, and trying to get the best deduction.
Because if you think about it, before this was increased, a lot of people itemized, and what was itemized, right? It's your mortgage interest, it's your real estate taxes, it's your charitable donations. Used to be miscellaneous itemized deductions and medical expenses, possibly, depending on how much you have. So what we're seeing, as Sarah said, when this got changed, a lot of people did itemize. But one thing I always tell clients, remember, especially if you're a Delaware resident, because they'll say, well, I don't think I'm going to itemize, so I'm not going to give you the stuff. Well, you might for state. You might for Delaware, because Delaware's state of deductions are so much lower. So it's still good to have that information when we're preparing your taxes to make sure to see if we can maximize. Now, if you live in Maryland, if you itemize on the state, you have to itemize on the state. If you don't itemize on the state, you can't itemize on the state. So it doesn't work matter, but in Delaware it does.
Yeah, when we talk about bunching too, might mean that you take your charitable contributions that you would make and maybe make them all at the end of 25 or also 26, and maybe combine years to get you over this and to get the max benefit for it. So that's what we mean when we say bunching. Okay, now there's this bill also created a new charitable deduction, and this is for those who don't apply. And this will be starting in 2026. And so now you can take an above the line deduction for 2,000, and this very Twilight joint or 1,000 for single or in a household. And as you take this if you don't apply, you can't do both. So you take the standard that I talked about. This is for monetary contributions only, so this does not include take to goodwill or get other reason for that, those kind of things. It also has to be qualified organizations, 501c3 charities, and not donor advised funds. Normally, you itemize, you can take a deduction for contributions to donor advised funds. So this is a little different. As always, you should keep documentation, especially if you have an original donation that's $250 or more. Then you definitely need to have another charity your donation, or that no goods or services for that. And so again, you can't double that. So this is just, you take this if you are not finding deductions.
And Sarah mentioned there, and you might hear us say this a couple times over some of these slides where it says above the line deduction. And what that means is think about your adjusted gross income. So you have all your income, your W-2s, your K-1s, interest, dividends come down, and there's some deductions above the line to get you to adjusted gross income. So you'll hear us say that, and that's what that means, is that I have all of your income, and then if I do the 2,000 there, I get 2,000 off that, then I have my adjusted gross income. Then I go into my standard deduction, so forth and so on. So that's what that means. It's a nice little deduction too, because a lot of people, like we said, don't get to the standard. Don't get to the itemized and still get a little bit of deduction. And I did want to mention one thing. Sarah mentioned donor advised funds. Danny was talking about bunching. And so, Sarah, that's a good thing. Donor advised funds are like the community foundations and things like that, where you give a ton of money right away. Okay. But you don't want that charity to have it all right away. So you set up a fund, a donation. So let's say I want to put $50,000 in this fund because I want to support the artists. Okay. Well, I give it to like a community foundation, some other organizations have donor advised funds. And I get a $50,000 donation deduction today, but then it goes out to them as you see fit based on the fund. And it can go out a little bit a year, percentage a year, or whatever you want to do. Give it all away 1 year. And you have say in how that is invested. So it's a nice little perk. Donations.
But did I understand it's just cash?
For this one, for this correct. Okay. Itemized, you still get non-cash.
Okay.
If you reach that left right. And there are some ways with donor advised funds that you can do some non-cash stuff too, like a boat or cars or possibly stock. Yeah. Yeah. Keep going.
Hello, I'm Keith Gunn. I'm a partner here at Faw Casson. I've been in accounting 15 years. I primarily work in the audit and assurance space, but not just station assurance space. However, I do enjoy working with those clients on tax planning, tax strategy, getting deeper into those financial statements and figuring out what we can do from that next level down to help with tax strategy. Again, for taxes play a big role in business strategy and business ideas. My career's been a little varied. I started my career actually as an internal revenue service auditor. It's been reformed now, so I'm reformed. But it was a great opportunity, great perspective to learn a little bit, come around here and get to taxes. So this next section of the bill of our presentation really focuses on, I'll say these are some of the deductions that were real big in the media, real outed items in the bill. Unfortunately, they're temporary. They exist for years 25 and 2028. So they are going to go away. They're written to dissolve at the end of December 31st, 2020. The first one we want to talk about is the tip deduction. Any point on this before we dive into tips? Well, the portion of tips where all your tips are deductible. Yeah, we'll talk about the deduction. They're not excluded from FICA taxes. You pay your Social Security and Medicare taxes on those tips. They'll be held by the employer, or separate, or however, and how the tips come to you. They are still included on that side of the equation. So the tips that can be excluded from taxable income potentially must be included and reported on your tax return before consideration of tip deduction. They must come through either your W-2, 1099, or self-employed. There's other forms too. Those. Again, this is an above the line deduction. So we talk about income, after total wages and tip income, and then another section where you deduct your tips, and then we get to our AGI, which is our line. The deduction is for tips received only on voluntary tips. There's still some wording out there that we're looking to clarify. Nothing's been said yet, but voluntary tips is a bit of an issue. You know, if you go to a restaurant, you have that 6% or 6-person party gratuity, is that considered a voluntary tip? We don't know. At this point, that we're waiting on guidance. I think that could be a bit of a large challenge on reporting for the restaurants to try and carve that out. So we're waiting on some guidance to come through from that. So there's a little bit of question on pilots. The maximum deduction is $25,000 on tip income. AGI phase out. So if you reach a certain income level, it would be $150,000 single, $300,000 filed jointly. Your tip income starts to phase out of the threshold. And this is limited to people working in industries where tipping is considered customary. Restaurants, the hairdressers. So if you like today's presentation, you decide to tip us. Yes. Yeah, October 2nd. Yeah, they're going to come out. The Department of Church, they come out with a list of all the businesses they qualify. We should help here. It's interesting that it's only $25,000 at very filing joint. So even if it's $25,000 same circle. So it's both of you were married, or both of you were getting tips. It's only $25,000. That's not fair.
Yeah.
Overtime deduction again. A big touted one that we saw a lot in the media. So this can deduct up to $12,500 or $25,000 verified jointly from your taxable income being for overtime wages. Again, this is an above the line deduction. So get your total income, take that your deduction, get your AGI. So what this overtime deduction does, it applies only to that. When you have overtime, you're getting paid time and a half. This deduction only applies to that half time. So if you think about it, if your hourly is $20 an hour, your overtime rate would be $30 an hour. That half time is that $10 an hour piece from 20 to 30. You can deduct that $10 an hour portion. The kicker on this, those FICA taxes, Medicare, Medicaid, Social Security, are still going to be collected and withheld on that overtime portion of pay. The overtime must be reported on your Form W-2, 1099, or other specified form. There's some caveat in there or something. Not on those levels. And it phases out at $150,000 filed single or $300,000 filed joint. There is still some guidance work in process about getting that reported on your W-2 or 1099 for overtime. Both payroll companies already segregate overtime wages on pay stubs, which are a huge lift, but they just need to get that put on the W-2. That's in the process, and payroll companies need to be. I'm going to be looking at that. We're looking at that on our side to make sure the payroll people are picking up that. But I go with that as that guidance comes out. Yeah, so that's that's gonna be interesting. So we gotta make sure, we're gonna think about that when we're doing W-2s. Sure. Yeah.
So the state. Impacts.
So most states begin their taxable income based off your federal income. So that would be a reduction on the state, or at least for Delaware. Delaware has
We can be pretty certain about that. Now, some states, you get rid of the word decouple. Some states, don't follow what the federal government says. So, for example, like bonus depreciation, where Maryland doesn't allow bonus depreciation. Just get an add back. So the states will have to, some states will probably say we decouple that. We're not going to do it. That'll come out as, but Delaware most likely.
Car loan interest deduction. So this is a $10,000 deduction for car loan interest. It is a above the line deduction again for a new car, U.S. Assembly, personal use with a loan for the car effective after December 31st, 2024. So what is a qualifying vehicle? It is a car, minivan, van, SUV, pickup truck, motorcycle with a gross vehicle weight of less than 14,000 pounds that has undergone final assembly in the United States. We expect a list to come out to this. Please don't quiz us and ask us if your car qualifies. And we will look it up.
Why are they going to 14,000?
That's one being a personally used vehicle versus like working into or business vehicle.
And most
On that, it's yes, no.
And most of the time, if you're a commercially used vehicle, it's running through your business anyway, and that's interesting. For business asset is deductible. This is a personal, but it just didn't want people buying big cars.
And remember, this is personal on your business. You've always been able to write off the interest on these loans. So we're just talking. Oh, we are.
Yeah. Again, if you have this qualifying vehicle purchased in a proper time period and you do refinance, the refinance loan could be qualified as well. There's probably some check boxes to fill out when you're building out your loan payments. Again, this is an above the line deduction. So before we get to AGI, it is limited to $10,000 per return per year. With an AGI phase out of $100,000 for single or $200,000 filed totally. When the pretty quick phase out, it completely goes away after $50,000 above those phase out. Professional stuff. A senior deduction. Sounds great, Brian.
I'm guessing.
You gotta have fun. Again, so this is a deduction against income for eligible seniors of $6,000 per person per year on the tax return. This one is, again, an above the line deduction. So total income, senior deduction, AGI, and then you got your taxable income. This phases out relatively quickly at $75,000 for single, $150,000 for a joint return. One thing to note, this does not replace the additional standard deduction that had been in place for seniors as well. So you have the senior deduction of $6,000. A little further down in your tax return, there's still the additional standard deduction per senior, which is $1,600 per person on the return over 65 or $2,000 for a household. So this is an additional boost to that for seniors. Yeah, that's pretty much the gist of the senior deductions. Over 6,000 per person, 12,000 for married body joint income. And again, I do want to stress that the senior deduction, tip deduction, and the car loan interest at the overtime are temporary or retroactive beginning this year, 2025, and will expire December 31st of 2028. So that's all I should have 4 years. Specialized temporary deductions.
Yeah, and this deduction, if you had heard when this was all in the media before it was signed, that there wasn't going to be tax on Social Security, that's what this is kind of in place because they couldn't get tax credit. They're saying most of these people are on Social Security, so give them a little extra deduction, but you're still Social Security is still going to be calculated the same way it's always been calculated. Up to 85% of your benefits can be taxable. This gives you a little extra.
So now I'm going to talk about credits. Keith really talked a lot about deductions and used to frame the definition of those. A deduction reduces your income that you ultimately pay taxes on. But a credit actually could give you a dollar for dollar reduction of your taxes. Further, when I talk about credit, some are refundable and some aren't. So what that means, if it's refundable, that means you don't even have to owe any tax and you could get the credit. And then a non-refundable means you have to have tax in order to get credit. So just a couple, definitions with that, because as you probably have already witnessed, this bill has so many triggers with dates. You've seen 24, you've seen 25. There's some that are permanent. There's some that's temporary, like Keith just went through temporary. So we'll make sure we highlight that too. This bill is probably in my 35-year career, probably riddled with the most dates, credit deductions, phase outs, or aggressive expirations. So there's a lot in this bill. So we'll keep making sure we're putting that out. So the first credit I want to talk to you about is the child tax credit. And you're getting this on your return currently, it's for any qualified child that is under the age of 17. And right now you're getting $2,000. Well, this is going to increase now to $2,200. When it was previously $2,000, it was never indexed for inflation. It is now going to be increased and indexed for inflation annually. And a portion of that $2,200 is refundable. So remember, refundable means I don't even have to have any taxes to get it. That's $1,700. And this pays out, unlike Keith talked a lot about the $150,000, $300,000, single married filing joint. This is $400,000 filing joint. So this is a, pretty big increase to that credit and a good refundable component to it.
And you still get currently, if you're 17 or over, you get $500 if they're
Yeah.
qualified. That stays the same.
Stays the
They
same.
ain't changed that.
So the next one we're going to talk about is the child independence care. So we think of this mostly as daycare, but it can also be care for a dependent. So the act permanently, so again, we talked about temporary piece, we're kind of temporary. This is permanent. So now it takes the credit from 35% that it is currently up to 50% of qualifying expenditures. Now for children, there's an age limit. You can't have 16-year-olds, and take their camp, their lacrosse camp. Now, if they're disabled, you certainly can. Now, this phase out is a little complicated. So I did kind of break it down because there's a lot there. And it's a very low phase out that it starts. So basically, if you make $15,000 or less, your adjusted gross income, you're going to get the full 50%. But as soon as you're over the 15, then for every $2,000 above the 15, the rate drops by 1%, but not below the 35. Yeah, no wonder people have to go to preparers and professionals to get the returns set. So that's basically what that bullet point 2 and 3 mean. And then though, there's some low AGI phase outs, unfortunately. So $75,000 if you're single, $150,000 joint. So the AGI on this one is pretty low, whereas like Keith went over a lot that with 153, this is 75, 150. So a lot of people will be phased out with this, which is, kind of disappointing because daycare is so expensive. I know my infant granddaughter, it's like over $20,000. So that's a lot, and if you want to work. And so this is tough with 2 income households to kind of stay within that AGI, but it has been expanded. Yes.
If you are taking care of the aging parent, when does that parent become?
There are rules about a dependent, so support rules, and there's criteria of dependence. So if you meet those, then you can take them as dependent. And there's income rules too. So it's unfortunately a little complicated, but they can't qualify. You just have to make sure you meet the support and the components.
What if you're a grandparent watching your grandchild?
As long as, well, watching, doesn't qualify as
Well, like-
independence.
My daughter, her husband work every day. And we have there's pretty different.
That would still be a dependent of them.
Yeah.
Because they are,
Yeah.
it's a qualifying child. They are actually providing support. They're just doing it out of kindness of their heart. But they would have to live with you. There's over a 6 month rule. You didn't have to have so much income.
Well, they live on my farm. They're still hitting my pantry and everything.
You'd have to get them to agree to not, also not take them as dependents. So you might have a time with that one. But nobody make guardianship. Yeah. Yes, different case, yeah. Yeah, and I say the code is full of ands, ifs, or buts, and the whole dependent, good point, that is riddled with, ands, ifs, or buts for sure. And then we have the refundable. So we all know what that means now, right? Refundable adoption credit, and this is big. So used to be that this was not refundable, so you had to have income tax. This is now refundable, so that's incredible. And it's $17,280 per child in 2025, and the refundable amount of that is $5,000. And it now covers all types of adoption. So it doesn't have to be just a domestic adoption or a special needs adoption. Before, the code allowed for special needs. So now they include all of them. But of course, as usual, we have some phase outs. And you wonder, why? How did they come up with this weird 259, 190? We all think it's, negotiable points. It's like, nope, you wanted 250 and I wanted 275, so we're at 259, 190. So modify the EGI and it phases out completely at 299, 190. So and typically it's claimed in the year that your adoption is finalized, but there are certain expenditures that you can take the year before. So rarely is an adoption sometimes done all within a calendar year. When we started the process in November, you might not have your adoption finalized until the next year. And this applies starting in 2025. So again, this will be nice for anybody that started the process earlier in this year. They'll be able to possibly take the credits on their 2025 tax return.
Yeah, good stuff. One of the things I want to point out, Tammy, everybody's alluded on it, about these phase outs and how much credit and all that. So the way it works with tax law is you have what's called budget reconciliation. Okay. So the current Congress is Republican controlled, but they don't have 60% of the vote. That's like 51, 52% of the vote. So if you don't have 60% of the vote, you have to go through budget reconciliation, meaning if I want to reduce taxes, I got to find something where I can create some revenue. So they come up with these phase outs and things like that. There's some oddball things that got removed, some credit, like you'll talk about later, about energy credits, things like that. So that's one of the reasons why you see some of this complication, because they're trying to find ways where they don't spend too much money in tax savings. So I'm going to talk a little bit about some other things here. And you probably heard this in the media. They're called the Trump accounts for kids, or short tax. It accumulates acronyms. So this is a new thing. It's going to be a savings account for kids under the age of 18. Okay. So you can start it's kind of like an IRA for children. So, and they don't have to have earned income to put money in this. So typically right now we use tax strategies where if you have a business, we might have your child work for the business so they can get a W-2 and they can put that money in an IRA. Well, they don't need that. So the federal end, between 25 and 28, if you have a child born in those years, the government's going to give you $1,000 to start it off. You got to apply for that though. It's not going to go in there automatically. So we'll get guidance on how you do that soon. Now, so you can put $5,000 a year per child in these IRAs, okay? And your employer can put $2,500 in, and it's not taxable to you as the person receiving it. So, there's a lot of you get extra $2,500 to put into your child's account. Your W-2 is not going to reflect that, pay tax on it. These funds grow tax-free, just like an IRA. And if they're used for things like education, healthcare, or starting a business at some point, You don't have to pay any tax on it. However, if you don't use it for those things, you do have to pay the taxes plus a 10% penalty. And like an IRA right now, if you're under 59 and a half and you take money out of your IRA, just to take money out of your IRA, you're gonna pay income tax, plus you get taxed with a 10% penalty. Now, the contributions that you put in here for your child are not tax deductible. A typical regular IRA, traditional IRA, depending on your income limits and certain parameters, you may be able to take a deduction. Here, you cannot deduct it. It's just, but it is a nice thing to do to get the savings started for your children. And then again, I said the 2,500 is excluded. Now, this will go up every year for inflation. So every year when the inflation numbers come out, there'll be an index to increase. Yeah.
Can we give them to grandkids?
If the question is, can we give them to grandkids? The way the bill reads right now, it's 4 relatives can contribute. It doesn't specifically say it, but if they're a relative, so parents, guardians, or relatives, so I would say yes. Now they'll have final guidance, but at this point, I would say yes. The next one's 529 plans. So about 4 years ago, there was the Secure Act 2.0 that came out. And it was a bill, and it was very, very much about 401k plans, IRAs, and things like that. But they added, if you know about 529 plans, they're qualified plans. You can put money in for children for tuition. Similar as we just talked about, which is tax-free. As long as they use them for tuition, there's no taxation on it when the money comes out. What they've done is they've expanded the types of things you can use it for. So typically on the secondary and the elementary and secondary education. So with the 2.0, you can take $10,000 a year from the 529 plan and use it for private school for, K through 12. Whereas before you could not. It could only be tuition for college and university. Now they've increased it up to $20,000. So you can take $20,000 and use it for private school. Private schools are expensive. And you can use it for more things other than just tuition. You can use it for supplies, books, computers, things like that, if you wanted to. So even if the tuition's covered, but they got to buy a bunch of stuff for class, you can use some of this to help, which is a nice little benefit because these things grow and they grow pretty well. And then also again, the same rules for higher education when you get into the college years. And if someone doesn't go to college, you can transfer these to other individuals. Okay. Student loans. So this is just something that they've made permanent. So for about 3 or 4 years now, an employer could give their employees like $5,250 tax-free to pay down their student loans, which is nice. It's a nice perk as an employer if you're trying to attract talent. You could give them a little extra to help pay the student loans, they take a long time to pay off. So you could put $5,200 now, and 26 is because it was expiring at the end of this year. And 26, that's made permanent. So you can put $5,250 and it's going to be indexed for inflation starting in 27. So it's something that's really nice to offer some tax advantage things for your employees and staff to help them all subsidize their student loan. Okay.
Yeah, so go back to some dependent care, but this instead is really employer provided benefits. So this is not starting until 2026. The tax-free limit on dependent care benefits is now changed. Used to be $5,000, now it's $7,500, and that is for a married filing joint couple. But if you're filing separate, it's going to be $3,750. So this really applies to any kind of dependent care assistance programs that the employer has, and it covers the employer paid or reimbursed child care expenditure. So this could be tax-free to the employee. Why is that so beneficial? Because if they get it through their W-2, they're paying Social Security and Medicare on it. Then it's going over to their personal return and they're paying federal and state. So when you can do something, especially just like what Brian talked about with paying down student debt, the employee avoids some of that Social Security and Medicare. So you've just given them like an automatic, 7.65% relief, on that. So that's why some of these are really important that the employer does. And you can go and make it part of your employee's compensation package. So if you have people that are, have student loan debt, have young children, there's so many opportunities to maybe pay for things directly for them and avoid that Social Security tax. So
any employer should really review their own benefit plan. Again, this is employer driven. We talked about the individuals with childcare. This is employer driven, and it's not until 2026.
Yeah, just another caveat. When that flows through to you personally, if you are a receiver of this, you have to spend the money. So
Yeah.
there's where Tammy talked about the dependent care credit earlier. If you don't spend the $5,000 or the $7,500, you don't get the, so whatever you don't spend becomes taxable. Then also both parents have to have income. If one has no earned income and the other does, then it's going to be taxable. Because what they're saying here is that the one who doesn't have earned income is not working, so they should be able to take their child. I'm just repeat the tax code.
But it's,
They're taxed, depending way you look at it.
So they put, as long as they get the money, the employer gives it to them, they use it for childcare that's not taxable.
All right, let's talk about expanded use of an HSA. An HSA is a health savings account. And now this can cover even more. And you don't have to be an employee to have an HSA. You can be self-employed and have an HSA. There are some rules around that though. So now you can use your HSA to pay for fitness programs, over-the-counter vitamins, and even some nutrition counseling. And more people qualify now. So this was the whole thing I was talking about with like the plans. So now if you have a bronze or a catastrophic plan, you now qualify, whereas before there were some limiters around that. And then part of this too is the dependent FSA increase. So I'm an employee and I choose to put in my flexible spending account, not to be confused with the health savings account, the flexible spending account, I could put money in pre-tax. It's actually before Social Security, Medicare, state and Fed. I could fund my dependent care FSA and then pay my daycare. Well, that used to be $5,000 and now it's $7,500. Now, again, like Brian mentioned with the previous one, this one, you do have to spend it. So you can't have $7,500 taken out of your pay and then only have spent $5,000 on qualified daycare that year. We do the reconciliation on your return and you'll end up paying tax on that difference. So again, there's some good increases for both employees and self-employed.
I mean, and HSAs are a really nice vehicle because you can max out your contribution every year in HSA, and those do transfer. Whereas, as Tammy mentioned, the FSAs don't.
Yeah.
The HSAs you can, and then just let it grow, and they just max it out. It's tax free when you're putting the money in. You're getting it pre-tax. Let it grow, so that when you're a little older in life, maybe you have all this huge health savings account to use for medical expense, and if you use it for medical expense, it's not taxable.
Yeah, especially for like really expensive dental work. I don't know if anybody's
Yeah.
used dental work.
Yeah.
Clearly.
But it's not for employer yet tax-free, right?
When you mean HSAs?
Yes.
Yeah, so when you're self-employed, you can put it in, or if you have a corporation and you're an employee of your corporation, you could do it just like any employee.
Because it wasn't that way though.
Oh, I feel it's just pretty, yeah, they're always available.
So, like for example, you're a partnership here. Okay, so
Right.
we don't as partners we don't get W-2s, but we get K-1s, as many of you are familiar with your entities. We get to if I put money in my HSA, I get a deduction on my personal tax return for that amount.
Yeah.
I put my HSA.
That's good for partners, so we get K-1s, we don't get W-2s.
Right.
But if you're a corporation, you get a W-2, then you can participate just like an employee would.
So that's every year, you can only put up to that much, 75.
But it
But you-
accumulates
you don't
for
have-
it's not good amount
I got rid of mine.
For HSA.
for an
Me
HSA.
And it doesn't say, we get, so like 5-6 years down the road, I want to use it, it's tax free.
As long as
Yeah.
you use it for medical.
Yep, automatic, man.
I use it for medicine. So you have a big procedure or something and you got to come out of pocket and so whatever. Because also, when you have an HSA, you have a high deductible plan.
Oh, yeah.
So you have to meet the deductible. So they usually use your HSA money while you're meeting that deductible if you have a
Well,
lot.
you can use your HSA fund to pay for your premiums too. So a lot of people will do that once it's built up. They're like, okay, I'm going to use it to pay for premiums.
Just growing.
Yeah.
All right, this is a good one. I know a lot of you now can breathe easily because now you have $15 million that you can now exclude from federal estate and gift tax. So is everybody relieved? Yeah. And if you're married, you get 30 million. How about that? So pretty high limits. But I joke about that.
But in all the years that we've done taxes, it has been much lower in some years. And there was some talk of substantially lowering it. 5 million's been thrown around. So it's been lower in past years and has been talked about. So I laugh about it, but it is really good to have that. So this starts in 2026, and this doesn't affect your lifetime gift giving. So anytime, and I hope I'm not going on somebody else's slide with gifts, but anytime you give a gift more than $19,000 per person. So Brian's always asking me for a gift of 19. So if I can give him 19, I can give Keith 19, I can give Sarah 19 this year, and then I can give them 19 all again next year. My husband could give them each 19. So it's a great way of reducing your estate. If you give,
I get in that ball.
yeah, you want to share
I'll tell you too. I just got a question. We give away all the money that we earn,
Yeah, but
then we're not taxed.
yeah, if you're not right, then you give to the West. And a lot of people do it for estate planning.
So here's kind of the way I like to say with that question you just asked about giving money away. 'Cause I had someone in the presentation last week say, well, I'm dead. How are they going to come after me? Because it's
Be able to manage whatever the state is.
the state tax is 3% of whatever's over 15. Okay, so if I die tomorrow and I'm worth 15 million, $1, my $1 is going to be taxed at 40%. Now, during the lifetime, as Tammy mentioned, 19,000 a year. Nothing you need to do. But if I give $19,001 to Tammy, I got to file a gift tax return. I do to report that $1, which then reduces my 15 million by $1. So after I gave away my 15 million throughout my life, I die tomorrow and I'm still worth 2 million. That 2 million is going to be taxed by state at
That's
40%. Now,
Right.
Delaware doesn't have an estate tax, but we do have tax in counties for probate. There's other reasons. That's a whole nother conversation. But
So wait a minute, what you're telling me now is that I have that money in my pocket, I can give it to my grandchildren.
you can give it to your grandchildren.
And then it's like I don't have that money.
Let's say it.
I'm not being sarcastic. I'm serious as a heart attack.
Totally. Let's say, for example, let's just make some numbers up. Let's say you're worth $5 million right now. $5 million in cash. Make this up. $5 million in cash. That's all you have. You say, I'm going to give that $5 million to my grandkids. So now what that does, we'll file a gift tax return. We'll just ignore the 19 for a second. That's going to reduce my 15 million to $10 million. I still have, I'm still worth $10 million when I die. I'm good. So if you win the lottery tomorrow and you win $10 million, you have 10 million more you could give away. So you can give it away. You just don't have access to it. Now, there's all other estate planning issues there as far as giving things. There's trusts we can do where you can still have access, but give a gift. Yes, you can give up to that amount.
So if I'm worth X amount, sounds so bad, but I want to leave it to my 2 kids.
Yeah.
Now, do I split that, say, 20 million, and so down and back down to 10? I'm giving 10 to one, 10 to the other one.
It's combined, no, it's aggregate. So it's your whole estate, regardless of how many people are your beneficiaries.
Yeah, and if you're leaving something to a beneficiary, you're not gifting it during your lifetime, that's a different situation.
Yeah.
So in other words, when I die, my kids are going to take over my farm, my rentals, everything.
Mhm.
Now, do they have to pay inheritance tax?
Well, that's kind of what we're talking about here. They would have to get appraisals on those kind of assets. So appraisals on land, valuations on businesses, and then you would take your cash. IRAs don't count.
They ain't getting no tax.
Those have direct beneficiaries.
No.
Stocks and not stocks at which bond amount, but what the value is. So it's your estate, everything's valued, the fair market values of it. That determines then. So if it's exactly 15 million, you could pass it to 10 people and none of them would pay, well, the estate wouldn't pay any tax. But if you're over that, it's just the dollars that you're over the 15 million. And it sounds, and the nice thing is this isn't indexed annually. Never before, I should say never before in 35 years. I don't believe we've ever, I know we have never had an index for inflation ever in this. So this is going to be indexed for inflation now. It's funny because it said it's permanent, but in the tax rule, nothing is really ever permanent until it gets undone by, maybe a future Congress. So for right now, until it's undone, it won't expire. Like a lot of the
Tax Jobs and Creation Act back in 2018. A lot of that expired, and that's why everybody kept saying this would be the largest income tax increase ever because of the expirations. This isn't due to expire. So what this allows is more wealth to be passed. And I know 15 million sounds like a lot, but we are coming up on one of like the largest wealth transfers. And we have people that are sitting on, like you said, land, businesses that have been built up. And it sounds like a lot, but when you throw all that in, homes have more than sometimes doubled in price. So 15 million now, from what we see, you know, we have plenty of clients that are over that, but there's plenty of clients, you know, for great majority that don't have to worry so much about estate planning. So if you hear people say estate planning, it's usually to manage this so that everything you've worked so hard for, 40% of it doesn't go out the window.
To put it in perspective, early 2000, that number was $680,000.
Yeah.
So if you were worth over
680.
yeah, you were worth over 680, you're paying 40. So at the time, I think it was 35%
Yeah.
of that excess. Here, you've got 15 million.
At 680 was really easy to get to,
Hard.
you know, very easy to get to. So now, you know, it's a little bit more now. Nice.
So wait a minute, you were saying that 15 million is adjustable.
It's going to continue to increase.
So hopefully we can get up a couple more million.
Well, it'll be indexed for inflation. So it'll be compounds, you know, the effect of compounding, or it'll take some time. That's, you know, that's the nice thing, that it'll be indexed for inflation. So that's actually.
Yeah. Or stay married.
Yeah, yeah. Or say married is 30 million. And pass it the same. If you get your spouse, when one spouse dies, you get the step up and he takes this basically. So that's why for married people, we kind of just say you got 30 million because you did, you know.
And just to clarify, Tammy, everyone still needs estate planning.
Yeah.
Estate tax planning. Yeah, let's clarify that.
Everybody should have signed to a will of trust.
Well,
Everybody.
Try- durable power of attorney, how to go directives.
Very, very important.
Clarify that.
And we actually work as a team with your attorney because it is so important. Don't just you're a great point, because just because you're like, oh, I'm getting 15 million, I don't need any estate plan. That has nothing to do with the protection.
There's a lot of other
requirements.
things that are.
Yeah.
Estate planning, I was in general.
Yeah,
insurance.
and we'll work with your attorney or refer you a wonderful attorney in this area.
Okay, so earlier we talked about the increase in the standard deduction. There also are some changes to itemized deductions for those who still itemize. A big one that I'm sure you've heard about is the state and local tax for SALT deduction. The Tax Cuts and Jobs Act limited that deduction to $10,000. We have a lot of clients that meet that limit. So now it's going to be increased to $40,000. And this is actually changed for 2025, so for this year. However, it does phase out for income limitations. So if your AGI is above 500,000 or very highly joint, or 250,000 you're entirely separate, it does phase down, but it never gets below that 10,000. So you won't be worse off than you are now. But some people will get that increase. So yeah. But this does end. It ends at the end of 2029. Unless Congress does something to extend it. But there was a lot of back and forth about this because people in the high tax states, like New York, they pay a lot of state taxes, and they were limited to a deduction of $10,000. So that was sort of a compromise with the 40,000. Another change, this does not come until 2026. There's going to be a new limitation on itemized deductions for those in the 37% tax bracket. Remember, that's the highest tax bracket. Before the Tax Cut and Jobs Act, there was a limitation. It's called the PEAS limitation. And then that was ended under Tax Cuts and Jobs Act. And so we have had that limitation for a few years now. So now this is bringing back the limitation, but it's different. And it's a little complicated, so I will go over an example in a couple minutes. But basically, your deductions are reduced by 2/37 of the lesser of your itemized deductions for the amount by which your income exceeds the threshold for the 37% tax bracket. So one way you can look at it is, if you're in the 37% tax bracket, every $100 of deductions saves you $37 in tax. But in this case, it's only going to save you $35 in tax. So it's as if you're only getting a deduction, a tax benefit as if you were in the 35% tax bracket. So that's where the 237 comes in. But again, I think it'll be easier to see in an example. So that's just going to be a limit on your total. Once you add a volume or itemized deduction, you know, your taxes, your charity, mortgage interest, all of that, then this is going to be a deduction. But again, only if you're in the top tax bracket at 37%.
Sounds like it's a good thing to have a tax person.
Yeah.
Yeah, right?
Exactly. Yeah, with the IRS, it's probably going to have to, out of our feet for all of this. Another new one, and this is also for 2026, so not quite this year yet, is a charitable deduction floor of 0.5%. So that basically means you're not going to get a deduction for the first 0.5%, and of your AGI. So, for example, if you make $200,000, you have to donate at least $1,000, then you can start getting a deduction. So, you make $200,000, donate $10,000 to charity, you only get a $9,000 deduction for that. $10,000.
And this kind of was talking about earlier about budget reconciliation. This was a way for them to find a way to not spend a bunch of money. You know, so it's-
Yeah, and this was only for the charitable deduction for itemizing. So that above the line deduction we talked about earlier, the 2,000, that does not impact that at all. So again, as we mentioned, 90% of people think the same for deduction, but if you itemize, you do have to think about these changes. We'll go through this quickly. It's, again, it may not apply to you, but say, all right, so starting in 2026, you're filing single, your income is $700,000. That means you're in a 37% tax bracket. Because that tax bracket starts at 626 350. And that again is the 2025. Critical, it will get indexed for inflation. And say you have itemized deduction of $60,000. Okay. So the first thing you do is you look at how much of your taxable income is over the 37% threshold. So that's the 73,650. That's the amount you're over because you make 700,000. Then you look at your itemized deductions are 60,000. So you take the lesser of those two, which is the 60,000. And then, as we mentioned before, you take that 237th reduction by 60,000. So that gives you 3,243. So that means your allowable deductions are 60,000 minus 3243, which is 56,757. So that's just, once you get down to your total deductions, itemized deductions, then it's further reduced. So you may come to us and give us all your deductions and you're looking at your tax return and say, wait a minute, I'm like $3,000 short. Well, it's because of this new limitation. And again, that's not until 2026.
Some other notable changes, as we said, this bill, and you can clearly see has a lot going on. These are a little smaller, don't apply quite to everybody. We felt we wanted to talk about them. We're skipping the space porch credits and Alaskan whaling credit stuff. Different things that might come into play. So miscellaneous itemized deductions, those are permanently disallowed now federally. So those are things like investment advisor fees, safe deposit box rentals, account tax preparation fees. Federally, those are gone. For the state, Delaware, they come into play. So again, like Brian mentioned, share those with us when we're doing your tax return. Those would come into play. Educator expenses, those are still deductible. $300 single, $600 married filed jointly. But in 2026, those educator expenses will be allowed as itemized deduction.
Yeah, that's kind of nice because we have a lot of clients that are teachers, and sometimes $300 or $600 is really not a lot. They're spending a lot more money on their students. So if they itemize, they now can. There's no cap on that. And they also expanded it to also mean this. I thought this was interesting to like coaches of teams. So if you coach the local lacrosse team and you spend money on that personally, you could qualify for this.
Mortgage interest deduction. So the cap total debt on mortgage interest is limited to $750,000 of acquisition and debt invest. That remains the same as it has been based on TCJA, but it is now codified and put in the law as permanent. So it's there until the next another Congress / change law. And mortgage insurance premiums, so that PMI, personal mortgage insurance, would be treated as deductible mortgage interest. Well, and that's deductible. Personal casualty losses and loss deduction are only now are one, they're permanently itemized, but they're only the losses that relate to federally and state declared disasters. So if you had a tree fall in your house, it wasn't fully covered by insurance, you could take that loss before. Now, unfortunately, you can't. It only has to be effective for state disasters so that you're fall in your house. Wow. Qualified transportation fringe benefits, not a huge one here, but there were exclusions for employers that provided transportation benefits. Those have been fuel modified and disallowed as expenses. Moving expense deduction, pretty much gone for everybody except for certain members of the intelligence community. So that was for military and military.
They added the intelligence community to the military definition.
So if you move for a job over a certain distance, you can take that deduction. That's no longer allowed to be moved for employment. Unfortunately, that's not a deduction anymore. And gambling and wagering losses. The deduction for gambling and wagering losses is still limited to the expense of income, but you're only allowed to deduct 90% of your losses compared to your gambling income. If you itemize, and that income doesn't be reported as taxable income, and that's deducted down. It's itemized deduction.
So like in the past, if you won $10,000 in slot, but over the time of the year, you spent $12,000 in slot to play slots, and you itemize, you take $10,000 deduction to offset the income. They've just limited that to 90% now. So it's slots. Thanks. All right, investments in real estate. So I'm going to talk a little bit about this. So this is something that I wanted to put on the slides because it doesn't happen very often, but you hear about it. I get a lot of questions about this. What's called qualified small business stock. This has been around for a long time. Okay, it's something in the tax code that's kind of what I like to call loophole, but you got to meet certain parameters. So if you get started way back, I think in 03, where you can take, if I went up, create what's called a qualified small business, and I'll get into that in a minute, and I sell my stock in the company, my shares in the company, someone else, I can exclude 50% of that gain in my income tax. And then in 09 to 10, it went to 75, and in 2010 through July 4th to 25, when the bill was signed, you can get 100% exclusion of the held for 5 years. So what this all means, and I'll talk about the new law in a second, is that a qualified small business that qualifies for this has to be a C corporation, which means the entity pays the tax, not you personally. A C corporation, and not many people are C corporations who are small businesses anymore because you end up getting double taxed. Because the C corp pays the tax, and then you take the money out, and then you pay a tax by taking the money out. So you can get well into the 55% tax. Take state consideration on your C corp small business. And most small businesses take their money out of their company, right? That's why you're in business. So you have to be a C corp. And then it has a very narrow definition of what types of businesses qualify for this. So for example, hospitality doesn't qualify. Farmers don't qualify. There's a couple service businesses like CPAs don't qualify. But then what happens is, if you do qualify, I've only seen it a half a dozen times in my career, but one of them was an intellectual property. They created a software, and they created this C corporation, and they wanted to raise money, so they went out and sold all these shares to raise money to fund it. And then the people who held the shares held it for 5 years, sold the shares back to the company, and had to pay no tax on that gain. But the problem is, and a lot of people who are small business like all of us, it's really hard to sell your stock. So if you came to me and said, I want you to buy my business, I want to buy your assets because I get to depreciate those assets. I get to help subsidize my buy with the tax savings. But if I buy your stock, I snap it to your shoes as in the same corporation, it's the same employer identification number. And all I do is just start running the business that way. I really don't get any tax benefit right now for doing it. So it's very, very hard. So if you went out, if you qualified for one of these and you said to yourself, I'm going to sell the business in 5 years, but I'm going to pay no tax. How do I know I'm going to be able to sell the stock? It's a big risk because if I don't sell the stock and I sell the assets as a C corporation, the tax load is huge, huge. And you'd be like, why did I do that? So it's very hard, but like some of these businesses that are set up now, it's becoming more prevalent because there's so much private equity money out there. And private equity's buying up everything. A lot of times private equity don't care about buying assets. They'll just buy the stock because they want the cash flow. So there is more opportunity for it. But what happened in this bill is they've now spread it out. They said, okay, after July 4th, if you held it 3 years, you get 50% reduction of capital gains tax, not taxed, 75 and 405. And then they raised it to where you could be screwed up to 15 million versus 10 million before. And there's some other parameters that a company can't be has to be less than 75 million in assets. So just something I throw out there because I get this question a lot. People call, say, hey, what's disqualified stuff? Chapter S, no tax. Well, there's a lot to it. So if there's something you're ever interested in about this in a little more detail, just give us a holler to talk about it. This one's interesting. Capital gains on farmland. So if a farmer sells their land to another farmer, they can take the gain on that land and spread it out over 4 years. You're going to still pay tax on it, but you're spreading it out. You don't have to give all your money to the government right away. And you could take, you pay your 1/4 the first year, you take the rest, throw it in an investment, make some money on your money, and then you pay the tax over the next 3 years on the rest of it. It's just, it's interesting that they threw in. Yeah.
What if you gift it?
If you gift it,
You're spread.
if you gift it, it's, so his question was, what if we gifted it? Gifting, there's no capital gains tax. Because what we were talking about earlier, remember the 15 million?
Yes.
Yeah, so let's say it's worth $1 million and you gifted, you're going to file a gift tax return reducing that 15 million. The receiver pays no tax on it because they're the gift, they're the one receiving the gift. So there's no capital gains tax. It's just reducing your lifetime possession. We talked about the 15 million. So gifting property, is a good thing to do if you want to give it away now and you want to get it at, if there's no, if that future appreciation you were worried about, things like that. But yeah, there would be no tax.
Really, and just to say, gifting though, the person you give the gift to steps into your shoe with basin. Whereas if you let it pass through your estate, the person who gets it gets a step up in basis. So again, there's tax strategies. Sometimes look for somebody will gift a highly, appreciated asset. And the person who gets the gift steps into the shoes of that super low basis. And that isn't always good either. So you do really want to talk to us before you're considering gifting today versus estate planning and letting it go to beneficiaries.
Sales and farms. So about, because I'm right now, I'm looking to buy another farm. I'm a farmer buying another farm.
Yeah, so that farmer that's selling it to you, could sell it to you, whatever, they have a gain on the sale, they could spread that over 4 years. You might want to tell them that. It might make them, they might say, well, I'll work with you, but I can spread it out over 4 years. Yeah. So it doesn't affect you because you're paying for it and you're buying it.
That is part of land,
Yeah.
not real assets.
Yeah, just the farm.
Like land. So if we're not building, that isn't going to be part of this. They carve out, like if you sold everything to include farmland, there would have to be carve out of
Yeah,
that.
just a tillable,
Oh, it's just cold.
exactly. Qualified tillable farming. So if you, let's just say, like to Tammy's point, do have building on the property, big barn, and you're selling it to somebody for $1 million, you just carve out a portion of that barn, maybe that's 100,000, and the rest is land. That's Johnson picking that up.
Why don't you have trees or some of that later?
There's that, but it's a great,
About that.
that is a
Yeah.
great question.
Yeah.
What if you have
Where
Trees, yeah.
on the lane? That is a great question, and that will come out in some
Yeah.
guidance.
Something like
They'll explain that. They will afford definition around qualified farmland.
Because some of that, I think what he's saying is, I'm starting to look into that. I haven't gotten very far yet. But they don't tax you on any tree, like you got acre of ground on your farm. That's what I'm understanding. So if you have an acre of ground, they don't tax you on that acre of ground because it has trees on.
Well, if you sell it to somebody, they tax you.
Oh,
Yeah,
yeah.
but I'm saying, but on your property.
Yeah.
I think, I thought, I'm just looking into this, and I thought it was tillable and tree. They don't tax you on.
Property tax.
Yeah.
Maybe for property.
Yeah, on sale and you'll be taxed. Now,
It's on
there's some
sale, the trees are relevant.
timber rules, on non-taxing of when you actually, use the, timber, but that's something separate. There's some tax advantages for timber.
Let's talk about a little bit more for business impact standpoint.
So qualified business income or QBI deductions. So this came into play in the Tax Cuts and Jobs Act 2017. So it's not really, not a huge new feature, but it really just the one big beautiful bill made it happen to that. So complicated, so a lot of stuff that become carpeted. So what this is a 20% reduction of taxable income or income derived from flow-through or self-employed operations. So you're a sole proprietor, a Class city, works for part of business, like a S corporation, or a partnership on a 1065, or even certain real estate that meets a certain criteria. 20% of that income is excluded from taxable income through the QBI deduction. There are certain fields that are assessed to specify service, trade, or businesses. These are businesses where the product is really knowledge that's being provided versus a service. Those fields, attorneys, law, accountants.
So they give us that.
We don't get that. So doctors, nurses, advisors, investment advisors, those fields, they're considered specified service trade business, and they have phase outs of this based off of income. We're not going to get it.
Yeah, but it's a great deduction because it's a 20% on the income potentially, and you don't pay piece for it, right? You're not spending money to deduction. You get it for free.
Fuck is depreciation. I deduct everything. Almost. So this existed in the Tax Cuts and Jobs Act, but it had a sunset provision where it was 100% dwindling down over some years. Well, this beautiful bill brought it back to 100% for assets placed in service. That's January 19th of 2025. Inauguration.
Yeah, I guess you can. It's anything before January 19th, you can.
You don't stop at 40%.
Say that again, please.
So if you bought an asset prior to so between January 1st and January and on 18th, if you bought an asset that's qualified for bonus depreciation, you cannot take 100% bonus depreciation on that.
Well, it has to be placed in service too. So placed in, you bought it, doesn't mean you were using it.
So that means I'm allowed to go out and buy some more equipment.
Oh, yeah.
Yes. So some of the must have a maker's depreciable life of 20 years or less to take a bonus. Again, includes things like computers, furniture, farm equipment, HVAC systems, larger vehicles, tractors, things along those lines.
We have a question from the audience. So would doing a 1031 exchange still be the optimal plan to sell a chicken farm where the buildings are income producing buildings versus sustainable bill?
Yeah, I mean, absolutely. If you can do a 1031 exchange, and a 1031 exchange is a like-kind exchange, meaning I have a piece of property, real estate, that I want to sell, doesn't matter, land, building, whatever, as long as it's real estate, and I want to sell it, I'm going to have a big gain. But I'm interested in buying another piece of property, something else. I can take that gain, roll it into the new property, not pay tax on it today. I'll pay, just kicking the can down the road to when I sell that property someday. I mean, you can do as many 1031s as you want, but there's specific procedures about doing that. You can't just go tomorrow, go to settlement and take the cash, put it in the bank, and then go buy another property. It's not how it works. There's a process to it, which is very simple to do. It's just a process.
Real property.
Yeah, real property.
So it's quickly lowering taxes. You spend dollars on equipment, give those reductions straight to your income for that payment. However, it can create issues. There is a difference in, if you buy a large piece of equipment and you're financing it, it create a tiny difference in your tax flow payment for that equipment and your tax deduction.
Yeah, I mean, all of us could probably have had the same conversation where someone says, how come I own tax when I don't have any cash? Well, maybe last year you financed a $100,000 piece of equipment and you're paying that over 5 years. We took a bonus depreciation of $100,000 last year. Well, now you don't have that deduction to kind of go against the amount of payments you're making on the debt. So,
it comes down to a lot of preference.
we have those discussions. We talk about that. We can spread it out over the life over 5 years before we can take all the bonus in one.
What kind of vehicles, if we're talking about, there's certain vehicles?
Pretty much anything is an insurance business. Pretty much anything. Now, if you go out, if Tammy and I go out and buy a big Beamer tomorrow and we just use it, we're not using it 100% business. So there's limitations. We don't use it for 100% business.
And there are vehicles considered luxury and not by thinking, oh, a Mercedes is luxury. Actually, luxury to the IRS is defined by dollar limit. So you can have some limitations on luxury too. So again, that's one of those ends of some mud section.
So should run our papers.
I'll forget. That was my question. There we go. Section 179. So this is still in play. Not huge changes to section 179 with the big beautiful bill. Really just changing the maximum deduction and some of the criteria for claiming this. So 179, the maximum deduction you can take is $2.5 million per year. It applies to machinery, computers, equipment. Very similar to the bonus. However, it doesn't include things like land improvements. So there's some difference between it. You want to limit it, if you put $4 million of equipment in service or more, you're not allowed to pay section 179. It was related there. So why both bonus and 179? There's some interesting tax strategy you can do with this. With bonus depreciation, say you bought a bunch of farm equipment and you want to elect to take that. That's all, could be 5-year class equipment. If you elect to take bonus depreciation, all your 5-year class equipment had to be bonus depreciation. With section 179, make elections on what we want to take for accelerated depreciation on equipment. We can pick half the tractors or even part of the tractors. You don't have to take the full dollar amount of everything placed in service. So it can really kind of help you. You can choose the depreciation you want to take to get to that income spot that might make a little bit more sense.
And yeah, exactly. You might want to say to yourself, I don't want to write off all of this year. I want to spread some of it out. And the other thing is section 179 doesn't allow you to go into a loss situation, whereas bonus depreciation does. If you really wanted a loss to help offset something else there. And again, say a potential challenge with cash flow. If you take a bunch of depreciation at the year of purchase, you may not have that cash when you're financing those equipment, make those payments. It takes you your comfortable higher tax. 179 will allow to smooth some of that out, just smooth out some of that depreciation.
Where you have to be careful is you might take 139 on a vehicle that qualifies 1 year and you have no tax basis in it. Maybe you like to trade in your cars often. You can't do a like-kind exchange on a car. So 3 years later, you trade in that car and they give you a trade value of $75,000. You're now picking up and paying income on that $75,000. So a lot of times we'll talk through, like Keith's saying, strategy. Do you want to do that? Do you also want to do this with your taxes? Do you want to be writing everything down and you're down to zero, but then the next year you have nothing and now you're up to 37% and then you're down here? Or we're going to meet with you and try to equalize a little bit and average it out so that you're not constantly yo-yoing too. So there's a lot of strategy behind bonus in section 179.
We have a question. Does 179 was bonus depreciation, how the state charges used for personal business property tax?
I don't believe that's
Yeah, that doesn't have any impact on property tax. Yeah. As far as that's concerned, property tax is based off your cost or fair market value, and that's nothing to do with from a property tax standpoint.
No, it's for business personal property. When the state charges you for your business personal property, I depreciate it 100%.
Yeah, most states on the business personal property don't do it based off depreciation, but some do. So it all depends on the state. We have to look into that. But like, for example, Maryland personal property, they look at the cost. The depreciation doesn't even come into play, and then they take an assessment based off the original cost and how many years passed to come up with the personal property tax.
So if you buy 2 cranes that are $4.1 million, you can't take 179.
But you can take a bonus for bonus potential. You can take bonus.
So now the bonus is back.
when you have to bonus, and you have to bonus both are great.
But you can like some 179 because it starts to base out. So for every dollar it goes over 4, you lose $1 or something.
Yeah. Yeah, it's not like a firefighter where it's on or off. Okay, R&D, that stands for research and development. Now it's fully deductible. So before you had to spread this out over 5 years, research and development, when you spent money on research and development. So businesses can now deduct all of their US-based research and development R&D costs if the year they're incurred. So no longer do you have to do this spread out over 5. And it can apply to wages, supplies, anything that's R&D related overhead, but in the United States. So now you say, well, when would R&D ever apply? It's really for that innovation. So think about your manufacturing or product development, and you're coming through and designing a completely different process. That might be where R&D comes into play. So this part though actually can be retroactive, and there's some specific rules on it. So it's only through 22 through 25, but it's only for companies that have gross receipt annually of 31 million or less. So there's to go back. So there's a little bit of a retro fix. So if you're like, oh, I was spreading this out, now you can go back to amend returns. Probably the reason for the years is that you can go back and amend returns three prior years. That's the statute of limitations. So foreign research and development, it's still permitted, but it gets slower treatment, and it's panned over 15 years. So that makes it tough. You know, company invests all that money, and usually it's cash that goes out, and they're getting the slow drip of part of that investment, you know, back. And the research and development didn't have to be produce any results, let's say. It really didn't have to. You just had to spend the money in this area.
And R&D, when you hear the term research and development, a lot of people think of it like I'm making widgets or something. I'm a manufacturer. Manufacturing is typically the companies that always qualify. But it doesn't, it's just if I'm creating a process, I'm creating something internally that we've created, potentially could qualify. We work with a company, a third party who comes in, has asks you questions and says, tell me about what you do. Tell me about some of the things you may have done on your own. You didn't just go out and buy a process. You might qualify. It's very important. Yeah.
For this R&D, what would be an example of a cost that I could not claim under normal business practice, but I now could claim?
Well, what I would say is it's just if you claim any deductions that you have, okay. But what this specific thing is anything related to research and development, and research and development is the cost that went into the implementation. Thank you. Of that process. So wages, wages, supplies, all the things that went into that specific issue that you're trying to create. And so and what that means is it was supposed any of that cost had to be capitalized and amortized over 5 years. I'm just saying now you can deduct it year 1. And it's very important that you do get a tax credit for R&D. So if you qualify for R&D, you get a 20% of the cost tax credit, income tax credit, dollar for dollar off your taxes. Now, whatever the tax credit is has to reduce the expense. You know, that had both. But at least you can expense everything now versus having it spread out in 5 years.
So BBB is really the only enhancement was the being able to deduct it all at once rather than 5 years. So the other thing Brian's talking about, it will always been in play. This is the enhancement to it.
So if I have a foreign and domestic team working on the same project, I can still expense, I can now expense the domestic portion of my engineering team. The foreign portion of my engineering team, I have to now capitalize. Correct. They'll capitalize that for the labor expense and amortize over 50 years.
You know, just try to allocate your US based, part of the research wages, supplies, and costs.
Do you have to detail all that?
What's that?
Like you got to keep the record?
Oh,
If you want to apply for the tax credit, as 1%, it is a very arduous process, but it's worth it depending on how much dollars you're talking.
yeah.
Because does that product have to produce a certain amount on the other end?
No.
No, it could actually not produce any positive results and you can still,
Yeah.
scrap it.
Does your business, like I'm a farmer, does my business have to have an R&D department?
No,
Or just somebody trying to develop something?
It's heavily cost-based and wages. Well,
So you would have to track what, so if you have employee A and you're trying to create this new process over here, that employee is the one doing it. Those wages would qualify. We have to track that. But we do, like I said, we hire someone to come in and do it because they use engineers and things like that. And they give you this thing to give the IRS if they try to audit you, just to make sure, because that's what they do. So
and this is a little different than just internally, you have a process or procedure that you're just trying to tweak and improve. That's just the normal cost of doing business. We're talking about something, we're talking companies that spend hundreds of thousands and millions of dollars on this. Manufacturing is a very common industry. We're going to completely maybe change the production line process to make it more efficient. That's kind of what we're talking about. here.
These type businesses you just create this internal software. They create their own proprietary software, and that qualifies.
Yeah. What about like a launch of a new division? You're going into a market you've never done before.
Potential. So in those situations, I was asking about launch of a new business going into a new market. In those situations, we would bring that company and just have like a 20-minute phone call. Got you. They would say, "Tell me a little bit about it." They'll ask some specific questions, and they'd say, "Well, that might be something here," and then they would go further.
And they help give you an idea when it's worth it too. Because if you're like, okay, we're gonna invest 50,000, they could say the credit isn't going to pay
The fee they charge you and all
Yeah,
that.
this is looked at with the IRS when you take that. So you do want to make sure you're, securing that properly.
All right. So excess business loss rules. This is not new, but it is now permanent. This is very important. Put this on here because I've had people ask me about this. What it is that let's say you have a bunch of entities, partnerships, exports, or just one, and you generated a large loss in it this year. And then you have other income on your tax return, your personal tax return, you have wages, a W-2, maybe some interest and dividends, and some other rentals or whatever it is. You create profit. You are limited to how much those K1s can flow through and take a loss. And the current limit is 626,000. So basically, I'll go through a quick example, but in real simple terms, if I have, let's say, $1 million of losses from my entities that are flowing through to my personal return, and I have $500,000 of wages, I'm going to be limited to the 626. I can't take the full million. This is a very important because people will say to themselves, "Well, yeah, I got this W-2, I've got this interest and dividends, but I got all these losses flowing through. I'm going to be fine." And they get to there, they realize, "Well, I can't take all those losses." You don't lose them; they carry forward, but get limited. So, like an example would be, let's say, for example, we got a married couple, and the total deductions from their business is 1.2. The total income is 400,000. So come down here, we talk about what is excess business loss is. But here's how you take the 1.2, right? And you take that 400,000, so your threshold amount is 6.6, which is the highest tax bracket. Take the 400,000 plus the 6.6. That's how much of income. Pardon me, I'll line that example. But your excess business loss is $174,000, which is the 1.2 deductions that you had, less the limitation of 1,026,000, which is the 626 you're allowed, and the 400,000 of income you had. So in my example, it's essentially, in this example, excuse me, if you take the 400,000 plus the 626 that they're allowing you to take, then you have a total of 1,026,000 you can take against the loss. So I have 174,000 that I have to carry forward to next year that I can't take. So for example, if you had 174,000 of other income somewhere, you're gonna pay tax on it. Just not gonna get to take all of that deduction. So it's kind of important because I've seen it a few times where, we do a lot of tax planning, so we know about it, but once in a while you'll get a new client and they'll say, "What's this other income number on my 1040? Well, that's adding back the loss you couldn't take because you were limited. So then this one here, doing that one.
Yeah, this is interest deduction back to EBITDA. So again, a lot of things coming back to the tax cuts, the jobs act that were put in place. There was a limit to the business income, business interest that could be deducted. This now alleviates some of the high leverage deductions or deductions in the high leverage business, a ton of debt, a ton of interest expenses. Initially, when Tax Cuts and Jobs Act came in, the threshold for the calculation was EBITDA calculation, which is the high threshold of your tax of your income, and then you were limited to 30% of that as your interest expense. Over time, with the Tax Cuts and Jobs Act, it sunsetted down. Keep it threshold for your income level that was then calculated by 30%, which was much lower level. Beginning for years starting after December 31st, 2024. We're back up to that EBITDA level for calculating the deductible interest at 30% of your EBITDA level. This is should be changed. This does only apply to large taxpayers. So it's the 30 million of revenue or more per year. Factors of the small businesses that are, have a lot of debt still, they're okay. They can take their deduction at the below 30. We've almost seen it a few times where someone was over 30 million revenue and they had a lot of leverage debt, a lot of debt. So they weren't allowed to take all the interest potentially. But now, even a calculation earnings before interest, acting depreciation, amortization, you're not going to run into it as much. We're almost there, folks. Almost there.
Yeah, so this, there's been a credit for employer provided childcare for a while, but this bill has, significantly increased credit. So it's going from 25% of qualified childcare facility expenses up to 40%. And it actually is 50% if you're a small business. Like you mentioned, a small business is 31 million or less. And that's index to inflation. So, you know, a lot of people will meet that. So this is an employer provides, say, a childcare center at your office. And there is a limit, but that has also been increased. So it was increased from 150 to 500,000. Again, it's up to 600,000 if you're a small business. Let's say most of our clients would be considered a small business. So this is a really great credit. Like as Tammy mentioned, we all know childcare is really expensive, and this is a great benefit for employers to provide for their employees, and then they really get a good credit for this. And this starts in 2026. So there's a credit already, but the enhancement is in 2026. So
And another thing where this could work too is you don't necessarily have to build, you get some credit if you, let's say you contract with a childcare organization and you provide the free childcare for your employee, you can get some credit on that as well. You actually get the whole facility.
okay, I think it also said you could join with other companies and get offered childcare jointly. So that might be a good opportunity for several small businesses to do that together.
But we don't have to build a facility. We can, like, say you're at daycare, I pay you, and then we get a bunch of them together. Say, hey, we pay you one lump sum to watch all your kids.
Yeah, so if you have like 10 employees, you say, I want to provide free childcare for their employees, but you're going to pay me. Yeah. All right, opportunity zones. How many people have heard of these? Yeah. So this came out in the Tax Job and Creation Act, and this was expected to expire at the end of next year. This is a nice little tax deferral technique, so to speak. So it's now extended and it's not going to have a sunset date. So the way it works is, and I'm not going to go back into the old rules because a lot of those have already passed, but in the current way it works is if I want to go out, if I have a big capital gain and I don't want to pay tax on it, I don't want to do a 1031 exchange necessarily, I can invest this in a qualified opportunity zone fund and not pay tax on it for 5 years. And most of the time, there's a lot of investment folks or investment firms that have opportunity zone funds. Opportunity zones are designated by the state. Meaning there's zones they're trying to generate economic increase in the states. Identify them. They're going to be expanding them to a lot more areas than we currently have. But a lot of investment folks have a fund you can invest in. You take that capital gain, you put it into the fund. You don't pay tax on it until the end of year 5 on the original capital gain. Okay. So you kick the can down the road, you let your money earn, you let your money grow, and then you get to year 5, you pay the tax on it. The benefit really comes if I keep that investment for 10 years, any appreciation from the day I invested in it, after 10 years, I pay no tax on it. And so that's a pretty sweet deal if you can find the fund for you. So the other side of the coin is I'm investing in an opportunity zone fund, but maybe that fund is a risky fund. Maybe I'm not sure they're going to make any money. And I'm losing money while I'm going to just try to invest. And I never really do get any appreciation on my 10-year. Doesn't really make any sense. But there are some folks out there that are doing a good job in creating these funds, building apartment buildings in areas that are designated opportunity zones and building, trying to create more economic growth in those areas. So if you do want to do that, it's something that could be beneficial for you down the road. I've only seen it since the tax jobs creation. I've only had 2 clients who've done it.
most business owners and individuals have to send 1099s to businesses or individuals that they pay $600 or more to, and then you have to do a 1099. I can't stress enough how important it is to meet the January 31st deadline for the year before. There's now IRS imposed penalties, and they are penalties that you cannot get abated. So you cannot argue really. So now a 1099K threshold, what that is if you get paid for your business through like Venmo, a third party, PayPal, those kind of examples, the threshold for you getting a form is 20K or 200 transactions. And 1099 to NEC, which is non-employee compensation. So I pay an electrician to do something in my business and I pay down $1,000. Well, right now I got to send them a 1099. Starting in 2026, unfortunately, we have one more year at that lower threshold. Starting in 2026, you only have to do it if you pay them $2,000 or more. And this is for rentals too. So in order for your rental to be treated as a qualified trade or business and you get the QBID that we talked about before, this is one of those areas that you need to be making sure that you're sending 1099s to any of your contractors that you use for your rentals too. So businesses and rentals, and there's big penalties now for not filing those per form penalty, and you cannot get out of those penalties. So definitely treat this very seriously. And we do thousands and thousands of forms annually for our clients.
Is that what our property manager is supposed to be taking care of?
Property managers don't often file the forms. Those are often done by tax professionals. Yeah, they they'll pay them and they might collect your W-9. So you should get, before you pay anyone, you should get the form W-9, because you wait till the end of the year and you no longer use them. And then you call them up and say, hey, can I have your social and address? And they refuse. It's actually on you, not on them. So before you give them the money, make sure you get the W-9 on file.
Because you only have 31 days to do this.
Yeah, and we've seen penalties actually start getting imposed, and they were forgiving that first year. Now they're not. So yeah, very serious.
And if we're doing a 1099, please give us the W-9s.
Our January is very interesting.
January, we're very into around here.
Yeah,
hard to believe.
insane. This tracking down.
Just they don't give you a lot of time to get them done.
I think I'm over.
If you held 10 different properties in 10 different LLCs, do you get that to 20,000?
No.
It's aggregate.
It's actually per person you pay. It's regardless of
I see.
how many entities or whatever. You don't get any kind of aggregation. So if I pay someone $500 from this company and $400 from that, that company, as far as the IRS goes, if it's common ownership, then they're supposed to. Yeah. So the common ownership rules.
All right, we'll run through these pretty quick. But we're just gonna talk, there's a lot in the media about clean energy credits that are going on. So it's good to know those things.
Yeah, a lot of these were either created or enhanced by the Inflation Reduction Act in 2022. So a lot of these are generally new, and they were scheduled to go away at the end of 2032. But this bill has now moved that timeline way up. So the first two are for keep that on your personal residence. So home improvement credit, that was a 30% credit off of windows, HVAC, installations. But that was generally capped at $1,200. That wasn't a huge credit. But the second one, the residential clean energy credit, this was a very huge credit, 30% off solar panels, geothermal. We have suppliers who got some big deductions for that. So those two are ending at the end of the year.
Yeah.
2025.
And that solar credit, I just recently had some questions on clarity on it. You have to have it in place and service by the end of the year. So
Oh,
if
it has to be built.
if it's being built and you're going to next year, doesn't count. You don't get the 30%.
Yeah,
you
so
get
that's
full
a big change.
What's going to be very so. Yeah,
Yeah,
you're
no,
going to lose the dirt you need to grow on.
When mine was going on my houses,
I got it. I understand, but
all right, then the next two credits are related to electric vehicles. These both end September 30th in here, so a month and a half now. So if you bought a new, electric vehicle, you could get up to a credit of $7,500. It was subject to income limitations, so some people weren't able to take the credits because their income was too high. Then the previously owned clean vehicle credit, that was $4,000. But again, it had the subject to income limitations, and that was pretty low. I actually don't think that many people take that credit. But yeah, those end September 30th this year. Then, alternative, vehicle refueling property credit, that's, for example, if you put in an EV charger, that's more related to maybe a business putting in, EV charging stations. That's ending in, June 30th, 2026. As well as the next two credits, both in June 30th, 2026. Credit for new homes, so that's in builders, constructed energy efficient homes, they had to meet certain requirements. They could get a credit. And then the other one, the commercial building deduction, that's for, say you're installing energy efficient, equipment or,
Lighting, something.
yeah, on your commercial building, on your business building.
Is there a limit on price for like say lighting? If I'm getting ready to put in $1,000 like
Yeah,
that.
yeah, it's also, it depends on the,
Yeah.
there's for stuff that, there's parameters that have to be.
Yeah,
met. Or
yeah, this is-
how you get to the energy efficient. I don't know those off the top of my head, but
We'll have to sit down and talk
yeah,
about that.
exactly.
Well, there's expiring.
Yeah.
So, yeah, so that's due June 30th, 2026. So we have a little more time on those. But yeah, just reach out if you need more information. And then there are a few other.
Yeah. Wait, you know, bunch of them. They just, now it's the big, again, budget reconciliation. So, look, what you gotta do, just, review your tax strategy annually, make sure you talk to us. There's things that are in play now, there's things that are gonna be expiring, there's things that are turning, which to do some long-term planning, but, always talk to us, let us know if you have questions, comments, concerns. Keep us posted of when you do things in your life, because the worst is when we don't know about it and then we realize it, then we have, band-aids in the business too.
So what sounds like to me, what they've done is they took a little here and a little here. Said, well, we're going to give you a deduction over here, but we're going to take it over here. So it's all going to balance out in the middle.
That's what they
They
tried.
really haven't.
It's not apples to apples, but it's close. Yeah, I mean,
What, are we going to benefit from it at all?
I mean, there's certain.
The bonus, the depreciation is on. QBRSD and still being around at 20%, awesome, for businesses.
Well, I'm looking for the farming and the rentals and, stuff like
But
that.
you do get a good bit of depreciation through that, which can bring your income significantly down.
Bonus is really helping the business and the rentals right now. We do want to invite you to tune into our podcast. We have accounting and accountability, but we really need guests. So if you would like to be a guest on our podcast, please see Denise. We feature entrepreneurs on it. We've had a lot of clients, people in the business community, nonprofits, financial institutions. So we'd love to have you on that podcast. And you could listen on any podcasting platform. Denise, is there anything else you need? We have some questions from the audience.
Um,
Hold on, just a sec.
I'll give you a few bumps, you rentals and the earnings under LLC and they're all listed under an LLC. And you have a contractor who does work under, different properties,
Yeah.
but they're all the same
Yes,
contract.
yes.
Can you total those up or does each separate property have to meet that dollar amount eligibility?
You do, because you are commonly owned, if they're going, then it's all under that LLC. If you pay that contractor more than $600 right now, you have to do the 1099. Now, granted, want to be clear, if the contractor is a corporation, like me, and not an LLC, you don't have to do a 1099. I'm not sure why it is the best. So if it's ABC Contracting LLC, you have to do a 1099.
But I'm saying together, like
Yes.
if you work at two different properties,
Yeah.
then
You would add it.
one.
Yes, you would add it.
You can do.
Yeah.
You don't have to do 6 different
Correct.
1099s. You don't have to do 199. Yeah.
And that would be good. Nice.
All
We
right.
had an online.
Yeah, we have an
question.
online question, Brian.
So
Okay.
I just got a couple of quick past questions from past slides that are probably just yes, nos. Do I need to provide my employees with tip documentation on their W-2, or do I just provide that documentation if they ask for it?
Oh, you mean for the new, potential
Yeah.
$25,000 exclusion from income?
Right.
Yeah,
My
it's
employees
just-
get paid via tips.
Right, so that's all gonna be reportable through the W-2s. So you won't have to give them any separate documentation. It's all gonna be on the W-2. So really, the compliance part of it's on the employer to make sure, especially once we get this voluntary tip definition, it's gonna be on the W-2, which it already is anyways. So the big point of it is going to be, was it voluntary or non-voluntary? On a W-2, there's already separate boxes for tip income. So that's gonna be all they need to file their individual tax return.
Okay, thank you. And then the FICA and Medicare taxes that are held on tips and overtime, does that include the employee and the employer share, both 7.25%?
7.65%, and that's not changed. Tips have always been subject to that. I had an industry that everybody was exploding because they're like, our tip income's now taxable. It's not. It's just always subject to Social Security and Medicare on both the employee and the employer.
And there's a tax credit, Brian, there's a tax credit if you're reporting the tips correctly and you're paying the employer portion, there's a tax credit to help offset them.
Okay, great. As an owner, if I pay myself a salary, do I get to include 12,500 of overtime for all my extra hours and I get that as the deduction now?
No, again, that deduction is not at the employer level. It's at the employee level.
Well, I think he was saying he's gonna pay himself, so he would be
Yeah.
technically an employee.
So that's a great
Because
question.
he's an employee at that
I
point.
believe that is not listed they don't identify that in the new bill.
So that's a
I
good thing.
think due to other regulations that are other code sections in the code, I think when the IRS does their interpretation and issues guidance, I think they carve that out, but you never know. So we'll have to wait and see. Hopefully they'll carve that out soon.
Because at the end of the day,
Defined
it's still family.
overtime though is hourly employee.
Right.
So if your
Right.
salary,
That's a good point.
overtime's not even gonna come into play. Most owners are not paying themselves an hourly wage. They're paying themselves a salary.
And most-
So,
And most owners can't pay themselves
Yes.
an hourly wage because they don't qualify. They're already qualify as exempt.
yes, so I don't really think, I think that's already been kind of shut down.
Yeah.
Already.
My next question was the same as Kristen's online. For the child savings account, is it only for new savings accounts or can it be for old implemented existing accounts?
You would have to create a new account. Yeah, it would be under this and you can only do it up until 18 years old to do the account. So
Okay.
you would start off an account tomorrow. And I mean, I don't know I'm not going to speak to the banks and this, but I'm going to, they're right there. But tomorrow you would have to set up a new account.
Well, doesn't our accountant do that if we need him to?
I don't want to.
I'm not, no. We might do on trying to keep some of it, not doing that, no.
You know of any financial institution that set up
Not yet. It's been 7 years.
And again, we don't want to put our financial institution in the room on the spot, but yeah.
So sorry, I have two last quick ones. Does the new bonus depreciation in 179, oh no, I already asked that about personal property tax. Okay. Is there a cap on the 20% self-employment QBI? Meaning if I have 3 businesses, is it just 20% for all 3 combined that I get 20% or do they cap? it?
Yes, there's also,
Unspecified trade or service.
yes, but
Yeah.
there's also a wage component to it. So it's limited to 20%, the smaller of 20% of QBI, which is basically the net income, or 50% of the wage that you pay. So there's ways that have been paid. Now granted, now remember, then you have losses in your business. You don't get anything because you don't have net income. So, and then what happens is if you have losses, let's say you have losses for the last 3 or 4 years in a business, that there's a carryover calculation to when you start generating income, it's going to not let you take that 20% for a little while.
So you have to kind of recapture all that, then you can start taking the 20%. But the good thing is permanent, it's not expiring anytime soon. Like Tammy said, plus there's new legislation down the road.
Yeah, we think we're at least secured through 2028 on a lot of things. That will call permanent.
Okay.
Feel like you did a very good job.
Presentation.
Yeah, yeah, thank you.
All right, well, thank you all so
Yeah,
much for
thank
being here. We appreciate it. We ran very long, but you know, we just,
A lot.
we like to talk about stuff. So appreciate you being here.
I know. Oh, yeah.